Hello, everyone. This is Savira Sahe bringing you the second half of the chapter number 2. I am going to share my screen so that you can see my slides and we'll continue. So, what we have here today is a flow of cost. What does that mean? We are trying to learn how do costs move in a manufacturing company. Remember, in the previous video that we had, we learned about some cost classifications, where one cost classification that we talked about, let me grab my pen, are product, pen color is not very good, versus period costs, right? I told you that product cost also means manufacturing cost, and this means non-manufacturing cost. So, in this episode, we are going to concentrate on manufacturing costs and wonder about what happens to these product costs or manufacturing costs. How do they flow through the company? Typically, we will see that, okay, I have to cut this out before I move further. Okay, I need to move this here so that I can see my slides. Yeah, there you go. Okay. All right. So a typical flow diagram of how the costs move say that the cost will move through three type of inventory accounts before they become an expense that you are going to see in your income statement. We'll talk about that later. Okay. So the first step is companies buy raw material. They purchase raw material and they store it. Okay. Next, the companies start making the product where the materials will get used. They will add direct material with labor and other manufacturing overheads like electricities and rent, etc., etc. And the product will start getting made. Okay, product will get completed and then it will move to the third step where we talk about finished goods inventory. So here we have products which are completed, ready for sale, and sometimes they get sold, but sometimes they don't get sold. But if they do get sold, then they become cost of goods sold. And I hope some of you remember cost of goods sold from your income statement. That is the time when they move from inventory to an expense account, because cost of goods sold is an expense of the company. That's the typical flow. All right. So until the time the goods are sold, okay, your costs are not expense. They are simply there in the inventory. Company is holding them, waiting to release them when the product will be sold. Okay, so if the product doesn't get sold, then the cost will stay in your ending inventory. And I hope again you remember from an financial accounting that they become your liquid assets. For example, raw material inventory, finished goods inventory are your short term assets. You are going to use them when the time comes. Okay, so we can talk about any kind of flow of cost as almost the story of a cost. Okay, in step one, company will buy the raw material, okay, and store it in a warehouse, storage or warehouse, right? Okay. Next, the production will begin. Workers are going to take your raw material from storage and they are going to start making the product. Okay. So, when you start making the product, you are going to require raw material. Obviously, you will require labor. You'll need something else. You might need tools. You might need a shed or a factory. You might need electricity, other utilities. All the things are combined. Okay. And product is being made, right? Third, if the product is ready, then it is going to move to finished goods account. Okay, now my product is ready to sell. Okay, if the product is sold, okay, then the costs are going to move from finished goods account to the cost of goods sold account, and cost of goods sold account then is going to show up in the income statement. That is the physical flow of all the dollar amounts that you are going to see in a company. Okay, does it make sense? We will talk about them with the help of an example also. All right, so as you can see, I summarized what I showed you here into the four stages of production, which we will need, saying stage 1, you buy raw material. Stage 2, you combine raw material with direct labor and manufacturing overheads. Okay. Manufacturing overheads are all those amounts that you require for manufacturing, but they are neither direct material nor direct labor. Okay. So all your factory rent, utilities, depreciation, all these kind of things are called manufacturing overheads. Okay. Next stage, you have completed product, meaning finished goods. Okay, and finally you have cost of goods sold, which is going to be giving you your income. Remember, revenue minus cost of goods sold is equal to what? Is equal to gross margin, margin, or profit. Okay, so this is what you see in the income statement in financial accounting. Okay, what we are showing you is the background to where the cost numbers come from. Okay, let us go in a little bit more detail so that we can see exactly the physical movement. All right, let's continue. Okay, so this is just a passing reference to the manufacturing versus non-manufacturing costs. I already talked about it briefly, but let us make sure that we understand that in all type of companies that are manufacturing something, there have to be three type of manufacturing costs. Every company will use small or large quantity, but direct material. They will also use small and large quantity, but some direct labor. And finally, they will all use some amount of manufacturing overheads like a place where they make things, a place where they can use electricity, tools, etc., etc. So three things are combined in making the manufactured product. Okay. Non-manufacturing costs are all those costs that are incurred after the product is completed. Okay. But needs other help. For example, it requires transportation, it requires advertisement, it requires administration costs like office expenses, etc., etc. So all these are called non-manufacturing costs. We are going to need this distinction, okay, when we go into our calculations. So let me just tell you that for these things, sometimes you might have seen a short form called S, G, and A. Selling, general, and administrative expenses. It is just a jargon, but sometimes it gets used. So I wanted to make sure that you understand what SG&A is. Okay. Let us erase this and continue. Just a detail of what kind of things can be called direct material. I'm going to differentiate between direct and indirect material soon, but let's just go with that. Okay, because we are just talking about inventories. In a manufacturing company, you can have three types of inventories. One is direct material. You purchased a whole lot of direct material, but you didn't use all of it till the end of the period. So you will have some raw material left. Similarly, suppose you are making a whole bunch of tables and chairs. 31st December comes and some of the tables and chairs are ready, but many of them are in several stages of completion. 50% made, 90% made, 99% made, but not 100% made. So they are work in process or work in progress. You could have that inventory. Remember, you can't call it raw material because it is not raw material. You've done a lot of work on them, but they are not finished products too because they are not finished yet. So we classify them as work in process or work in progress inventory. The third type of obvious inventory is finished goods inventory. Products are ready, they are waiting to be sold, but if they didn't get sold, then I'm going to put them in my liquid assets as a finished goods inventory. So we are going to look for three different type of inventories into a manufacturing company. Okay. Now let us go into a numerical example. We have a furniture company that makes, let's say, tables and chairs. Okay. What do? They buy wood. Okay. They add, combine it with other raw materials and other labor. Okay. So your step one, okay, direct material purchased and, oops, sorry, I needed a pen. Okay. So this is my introduction to a direct material inventory account. All right. Then I get out of here and I go to stage two, where workers are going to take wood from my storage and they are going to start making the tables. After that, I am going to add many other things that I'm going to require to production: rent, electricity, maintenance, other utilities, and so on. So combine everything that is required, okay, in the manufacturing, okay, call them manufacturing overheads, combine them to my material and labor cost, and I am ready to make the product. Okay. Now, product is made. Okay. Now it does not belong in work in process account. I move it from work in process account to the finished goods account. So finished goods account is almost like my retail showroom. The things have moved from my factory to my retail showroom. Now they are waiting to be sold. Okay. If I'm lucky and my tables are sold, then they move out of my finished goods account. They go into cost of goods sold account, where, as I told you before, it is going to be subtracted from revenue and I'll be ready to calculate profit. Okay. So these are the stages that we are going to repeat with the help of a numerical example. Okay. So again, recall, oh, I did not erase this. So let me just do this. Recall from financial accounting, if you can, that financial accounting relies a lot of journal entries and then T accounts. Okay, here, because our focus is on decision making, I am showing you the T accounts of the three inventories that I just talked about. I am also going to talk about each one of them as an equation, but I want to show you how the costs, okay, are like water flowing through pipes. They don't disappear, they just move from one place to another, right? So let us try to look at the picture one by one. I am going to need my pen. I think I need a better quality color here. Okay, so let us focus on the first account, this account. Let's just focus on this one. Okay, so it's a simple T account, okay, where I have some beginning inventory. If my company is a brand new one, okay, then I have beginning inventory of 0, right? Otherwise, I could have some inventory coming, let's say $10 from previous year. Okay. Then I purchase more raw material. When I purchase raw material, I just add it. Suppose I buy $90 worth of raw material. So now I have $100 worth of raw material in my hand, ready to be used. Either I use it or I don't. Okay. Let us assume that I use $80 worth of raw material. Okay. So now, given these three numbers and given your basic knowledge of financial accounting that debit side has to be equal to credit side, can you tell me what should be the amount of ending inventory in a raw material account? Should it be this? If your answer is this, then you got it. Okay. So notice in this account, we had four numbers: beginning inventory, ending inventory, something that came into the account like raw material purchases, and something that is going out of this account like raw material use. Okay, and you can see that I use this arrow to say that this is the link between account number one, if I can call it that, and account number two. This is the common link by which these two accounts are connected. What does that mean? Raw material, when taken out of the storage, okay, is going to the factory floor. So it is moving from one account to another. It doesn't need to stay there anymore. So I moved it. Let's suppose I moved $80 worth of raw material into this account. Okay. Now I'm going to combine material with labor and manufacturing overhead. Okay. Just to kind of add the numbers. Suppose my beginning inventory was zero. Okay. I used, let's suppose, $100 worth of labor. I used $120 worth of different manufacturing overheads: rent, electricity, utilities, depreciation, taxes, etc., etc. So I have a total manufacturing cost. Remember, I showed you on the previous slide that there are three different types of manufacturing costs a company can have: material, labor, manufacturing overhead. I combine all of them, so I have $300 worth of total on the debit side, given that my beginning inventory was zero. Okay. Now I put in some cost. Either the goods would be completed on 31st December or they would not be. Okay. Suppose I completed $250 worth of goods. Okay. Once again, can you tell me, given this basic relationship that we have between the debit side and the credit side, as to what would be the amount of ending inventory here? Okay. Is your answer to ending inventory of work in process 50? Why? The total of the debit has to be equal to total of credit. So if I have 250 here, okay, this number should be 50. Are you with me? Okay, great. Okay, let's clear and continue. Now notice that this number, because the goods are completed, they don't belong on the factory floor. Okay, now they are moving from here to here. Once again, you can see I had one connection between account number 1 and 2, and now I have one connection between account number 2 and 3. Now the goods which are manufactured are in the finished goods inventory account. Let us again assume for simplicity that I didn't have any beginning inventory. Okay. Now I have some goods that I have manufactured. Either they'll be sold or they won't be sold. Correct? So suppose I had $250 worth of goods that I had manufactured, out of which suppose $180 worth of goods get sold. Okay, I ask you the same question, my dear boys and girls. Okay, given that the total of this side is 250, you agree that the total of this side in a double accounting system should also be 250. As a result, what is the value of ending inventory? Did you get it? Is it equal to 70? Ending inventory of finished goods is equal to 250 minus 180 equal to $70. Okay. All right. So now I know my cost of goods sold is 180. I am going to clean this one up so that I can try going to the next account. Now you see this cost of goods sold is going to income statement. Okay. Once it comes here, okay, what happens? Remember, profit of a company, okay, can you say it? Profit of a company is revenue minus cost of goods sold equal to typically gross margin minus whatever non-manufacturing or operating expenses you can subtract will give you operating income. Okay. And since we are keeping our example simple, we do not have any operating expenses. Therefore, instead of calculating operating income, all we need to do is to calculate gross margin. How do we calculate gross margin? Given the cost of goods sold, if somebody gives me a revenue of, let's say, $400, Okay, then I know my profit should be 400 minus 180, okay, is going to give me profit of $220. Just want to make sure that I did a calculation correctly. So this is basically what you see in financial accounting. Okay, and all of this is basically what you learn in managerial accounting. That is basically the difference between the two. Where do numbers come from? And once I know where numbers come from, it is also easy for me to change them. For example, if my raw material is too expensive, okay, if my rent is too high, I'll be able to do something about it because I know where these numbers are coming from and where they are going. Okay, all right, let us go a step further. Okay, this is just the highlight of the four accounts one by one. If you kind of do not remember how T accounts are made or something, you can just stay with me. You don't even have to go back and brush up. Slowly, you will get it. If you don't get it, please ask me to explain more in the class. When we go over it, I'll be happy to do it for you. Okay, now let us go to the equation version of what we just talked about. For each type of inventory, I am going to generalize, okay, so that if you are not the T account type and you are the equation type, okay, then you will be able to solve the problems, every single problem you are given, okay, using the equation. Okay, let me kind of talk about the equation here using a slightly brighter color. Okay, what am I saying? Whatever I was saying in a T account, I am saying beginning inventory plus whatever I add, I call it transferred in or addition, okay, in any account, okay, has to be equal to ending balance or ending inventory plus what you transfer out of an account. Okay, now this is true for almost anything. It is true for your bank account, it is true for your relationships. How much goodwill you have plus how much you earn in a relationship, okay, has to be equal to what you use and what is still there. Okay, so if I take this simply as a T account, I will say if my beginning inventory of cash in my account is $10 and I add 100 more, I should have 110. Okay, this 110 either I withdraw or is still there in my ending inventory. Okay, so this is what this equation is saying. I say 10 plus 100 is equal to ending balance of 50, meaning what is this number? Balancing number of 60. So this is a trick to calculating any of the missing numbers that you can. Given any three numbers, you should be able to figure out the fourth by highlighting the yellow one. In this case, just as an example, I'm saying suppose you are looking for an ending balance. Okay, you massage your equation, you bring ending balance to this side, and you take everything else to this side. So $10, okay, plus whatever you added, okay, minus whatever is your beginning in withdrawals, okay, I think it was $60 of what you transferred out, okay, he's going to give you your ending balance. So given any three numbers, okay, this number could be missing, and then you can massage your equation and you should be able to take everything to the other side and solve it. These are some very common type of questions that you see in this chapter, which we are going to practice soon. So here we go, we practice. Okay, here is some data. All right. So again, stare at the data, guys. Sorry, my file kind of got lost. Stare at the data. What are the kind of numbers you are given? Try to get familiar with the type of numbers that you are given. Okay. For example, you are given beginning inventory. You are given direct material purchased, you are given direct material used, you are given total manufacturing overheads. Okay, you are given total manufacturing overhead, which means it combines variable plus fixed. Then it is giving you variable overhead, which means you can figure out what the fixed must have been. Okay, now it is giving you total manufacturing cost. You remember what the total manufacturing costs are? Recall, total manufacturing costs are always three numbers. Direct material plus, do you remember? Direct labor plus manufacturing overhead. Okay, now you are given beginning inventory of work in process. You are given cost of goods manufactured, short form this. Beginning finished goods, cost of goods sold, short form COGS. Okay, everybody all right? Let us clean this up a little bit to proceed further. Okay. Question is asking us to calculate ending inventory of direct material as question number 1. Okay. It is also asking us to calculate manufacturing overhead costs, direct manufacturing labor, work in process inventory at the end of the period. Okay. Similarly, finished goods inventory and cost of finished goods available for sale. Okay, there are all these numbers that you have to calculate. Okay, I could ask you to start working on, oops, I didn't have the pen, so I kind of erased it. Okay, on this right now, but on the next slide we are going to solve it one after the other. I just copied the numbers here so that you can see what the total numbers given are. Okay, I also copied the questions. Let us attack question number 1. I am going to again change the color so that it is a little brighter. Okay. How do you calculate? Oops, I didn't mean to do that. Okay. How do you calculate direct material inventory? Okay. Remember, one way to do it is to make a T account. Direct material inventory account. What do you have to remember? You have to remember what comes on the debit side. Sorry, my hand moved. Purchases. Okay. Ending inventory comes here, and then raw material used comes here. I simply write ending inventory here in a slightly non-conventional way so that it kind of looks like an equation, because you are not following a format. You are trying to calculate a number, and given that this total has to be equal to this total, it's kind of easier to have ending inventory here. So this is my question number 1. Let us say beginning inventory is $90. I took it from here. Okay, raw material purchased is given as 345. I know nothing else can come on the debit side, so I am ready to make the total. I have a total of 5, 3, and 4. Total of the debit side is $435. Okay, now it says raw material used is 365. You know that the total of this side is 435. Okay, can you figure this out? Okay. Another way of doing this is to use the equation, which says beginning inventory plus whatever you transferred into that account on the debit side, which is this, has to be equal to ending inventory plus whatever you transferred out of this account, which is this, because this got transferred out. Correct? All right. So now you can still fill in the numbers. $90 plus whatever you transferred into the account has to be equal to, let's call it X. Okay, and what you transferred amount is 365. So 90 plus 345 minus 365 will be equal to your X. So you got it. All right. Everybody with me? Okay. If you are, then let us hit the first calculation that we have here. 90 plus 345 minus 365 gives us ending direct material inventory of $70. Sounds good? Let's hit the second question. Fixed manufacturing cost for the month of March. Okay. Now think about, where is fixed manufacturing cost? Recall that you are given variable overhead. Is it asking? Oh, sorry. It's asking for fixed manufacturing overhead. Variable overhead is equal to 270. Total overhead is equal to 485. Okay. What does that mean? Fixed overhead must be 485 minus 270, right? Because total overhead has to be equal to variable plus fixed. Make sense? Okay. Let us check if our answer is correct. Oh, I have hidden it under this one. Okay. So just subtract 485 minus 270 will give me the answer to the second one. Okay. Now it says direct manufacturing labor cost. My question number 3. Direct manufacturing labor cost. Okay. Where will I find an answer to a question like that? Okay. For that, I need to figure out where I will find direct manufacturing labor. Remember, total manufacturing cost of a company is always three things: direct material plus direct labor plus manufacturing overhead. Right? Now, I am given total manufacturing overhead of $485. I am given direct material, actually I calculated, I have it, direct material used of 365. Okay. My total manufacturing costs are also given in the question as this number. So this is what my equation is looking like. Let's call this X. Make sense? Okay. So this would be my answer to question number 3. Sounds good? Let us erase this and let us see if my number has turned out to be correct in our table. Here we go. So we say total manufacturing cost is always a combination of three numbers: direct material used, direct labor, plus all kind of manufacturing overheads. Okay. So we kind of rearrange and we massage. Oh, I hit number 4 by mistake. Never mind. Okay. Number 4 is saying what is your work in process ending inventory. Okay. For this, I need to show you the T account. Okay. Since the equation is here, I'm just going to show you the T account. Remember, your work in process inventory account is beginning inventory plus total manufacturing cost, which is three numbers: direct material used, direct labor used, plus manufacturing overhead. These three numbers that we just added, okay, here. Then, what are the two numbers I have? Cost of goods manufactured, okay, which is actually given to me here in the question. And then I need ending inventory. So now notice, I'm given the other three numbers. I am given beginning work in process inventory of 215. I am given cost of goods manufactured of 1640. This should be a 6. I am also given total manufacturing cost of 1570. Now I make a total here. I subtract this and I should have the value of ending inventory, which is exactly how I have it here. Beginning work in process of 215 plus 1570 of this number minus 1640 will give me 145. Okay, so it's the same trick. You can kind of use it any way you want, as a T account or as an equation. It's the same idea. Okay, let us continue and go to number 5. What are cost of goods, finished goods available for sale? It's slightly tricky language, so I want to kind of show you the T account, we kind of call it gas, goods available for sale. Okay, so what does that mean? It says in a finished goods inventory account, suppose I had a beginning inventory of $160. Then I manufactured and transferred these many more goods. So how much more total is available for sale? So the total of the debit side is called gas. Goods available for sale. That's what the question is asking. It's a popular question, so I wanted to kind of show you how to do it. Now you have only one more step before you can do the final question, which is the finished goods inventory. Okay, remember you have two items on the debit side. If I sell the items, which is cost of goods sold, given to me here as 1740, okay, I have a total of 1800 here. I have to have a total of 1800 on this side too. Okay, which means my ending inventory should be 1800 minus 1740, meaning equal to 60. Okay, same trick I'm using. Given the three numbers, I should be able to figure out the fourth number, and this is where my calculation should be like. There you go. Okay, everybody with me? So these are the two main concepts of this chapter, video 1 talking about cost classifications and video 2 talking about flow of costs, okay, to combine into chapter number 2. Have a great day, guys. Thank you.